Hopefully by the next meeting, I will get it right.
I confess I don't see the minutes. I'm looking for them, but I don't see them.
Okay, let's look for the minutes.
I found them in the town's backup. I'm going to send them to everybody now.
The town's back. So Jared's email?
No, it's just in the town's website.
No, it's not in mine.
Stand by.
Could I ask a question? Would it make sense for these packages to go out a little earlier, like sometime mid last week?
They typically.
Yeah, we'll get them out earlier.
Thank you.
Okay, well, guys, why don't we, let's see, why don't we move, that's why we push on the minutes, we can come back to them at the next JRID meeting, we can do 2 minutes at the same time at the next meeting, let's not hold up, let's not let the enemy be the good be the enemy of the great here, right? So we'll table that for the next one. Let's move forward to item 3, which is the administrator's report, which I know is ready and is in that packet. So I invite, Megan is here with us, and she is ready to go. Please, I invite you, Megan, to please take it away.
Thank you. I just wanted to give a brief update on the Milliman implementation. We're proceeding with a planned October 1st go-live date with Milliman for the town participants in the pension plan. We're going to meet next week with Richard Cohen from Shipman and Goodwin to make sure everything is on track for that go-live date with all our plan documentation. Our historical payroll files have been submitted to Milliman, and our ongoing payroll files are now being sent on an automated basis after every payroll. So things are moving along in the right direction with Milliman. The July 1st cost of living adjustments have been completed and delivered in the July 1st pension. The notes here say we partnered with Wilmington Trust, and that's a typo. We partnered with Milliman. So we had our team at Milliman work with us to do the analysis on the COLAs for 7/1/2023. We identified 220 retirees that are eligible for the annual COLA. We calculated the new monthly pension amounts and submitted that to Wilmington Trust for payment, and we issued letters to the participants letting them know the 3% increase and the new dollar amount of their pension effective July 1st. We also identified 40 retirees who had been receiving annual cost of living adjustments who were eligible for a biannual cost of living adjustment. So we stopped that practice and sent letters to notify them that going forward, they will have cost of living adjustments delivered to them on the even numbered years. So their next COLA will be July 1st of 2024. I only had one participant contact me in response to that letter expressing their displeasure about that. The plan document says every 2 years, so we have to follow the plan document. They were all Board of Ed employees. We did overlook 6 police chiefs who have annual COLAs in their employment contract on which they retired. Everyone else in the police and fire pension is on a biannual basis. So now we're aware of the 6 police chiefs who received annual COLAs. We corrected them and got them made whole for the August 1st payment. So they're going to see a double bump for the 1st of next month, and then they'll go to their normal ongoing pension amount for September 1st. Also wanted to report on the retiree healthcare premiums. So we had our renewal with Anthem for our active employee population and for our retirees. Aon works to create the premium equivalent rates for those plans, and we looked at those premium equivalent rates for our retired population. That's 34 participants who pay a medical cost share, and we updated their premiums based on that renewal with Anthem. The letters went out to participants, and we worked with Wilmington Trust to get their pension deductions updated. And that's about it.
Can I ask you, Megan, a couple of questions? I mean,
sure.
Overall, how have you found it to work with Milliman?
Milliman's great to work with. They're very detail oriented, and I like things to be right and to be by the book, and they like to be things right and by the book and programmed. So some of the challenges that we're encountering are getting stuck in the details because we all want it to be right and to be programmed. So something like these police chiefs who don't follow the standard are difficult, but we're working through these anomalies as we find them and coming up with ways to get them into the system so that it's going to be ongoing and not a blip every year.
And if you were to characterize kind of how far along we are to kind of 100% transition, how far along are we toward that point?
Well, without the final plan document, we can't go live with them. So that's really the thing that is causing us most anxiety, is getting the finalized, revised plan document into the hands of the retirement board, you fine folks, and get all of the updates from Shipman and Goodwin taken care of and presented to those who need to see it. So right now, 0%.
Got it. One of the wow. The ghost in the machine. And the kind of the feedback thus far from the plan participants and retirees and employees. I mean, you mentioned one letter. Generally speaking, you know, that was one of our concerns. Just was, you know, the response and the general, just generally how this would be received from your perspective. It sounds like it's gone okay.
It's going okay. Unfortunately, I'm often tasked with delivering unpleasant messages, like that they're being undercharged on their medical premiums or they were over applied a COLA. So they don't like the message that I'm delivering, but all the participants seem to understand that the goal is accuracy, and everybody wants accuracy. So it's going well. I'm not making friends, but everybody's on the same page that we want the data to be correct.
Thank you. Anyone else have questions? Chris?
Yeah,
Chris?
sorry.
Oh, in general, how are you finding the level of errors that needed to be corrected, and do you think that we're on progress to kind of keep to get everything squared away? You know, how confident will you be that we're 100% when we go October 1?
Every day I'm more confident that we're honing in on all these errors and we're going to have a greater accuracy every day. I would give us like, I'm going to say we're going to be 85% at go live, because things pop up because we look in the files. So there's one error makes me look at the whole file for a participant, and there may be another error in there. Everything has been so manual and open to interpretation in the past that with standardization, we're finding things were done differently, and sometimes we can't go back, but sometimes it is right to go back because of an error that was made in 1986 or something like that.
So-
Just to follow up, is there a process or review process that if someone disagrees with the calculations, and how are you guys handling that, and how is your staffing? Are you guys able to handle this along with all your other work and that kind of stuff?
I think I have one person who disagrees with the application of the COLA rules. So there's a summary plan description from 2015 that indicates cost of living adjustments will be during the assessment period for the consumer price index between April 1st and March 31st, and that the participant must have been retired prior to April 1st of that year. And we're determining that year to be the measurement period. So they must have been retired for the entire measurement period to be eligible for a COLA. And I have someone who disagrees with that assessment. So I brought it to Richard Cohen, the attorney who advises on the pension plan. So when someone has a disagreement like that, we talk about it internally, and then we bring it to Richard if there's, discussion about, well, I can see his point, his confusion about the plan year. He was told by the prior administrator that he would be eligible. So we bring those things to Richard. And the staff is stretched pretty thin, but we're trying to keep everything humming along, and all with the goal of accuracy and getting people what they need. And it's a big life event, retiring. So sometimes people need a little bit more, they want to talk a little bit. So I want to listen and be friendly, and it's a big deal to retire. So it's managing the numbers and the life change too. That's sometimes a challenge, but everybody's walking out happy for the most part.
Eric?
Megan, thank you for joining us.
Hello.
So 2 questions, and the first one I have to ask. I am very familiar with the police fire pension trust booklet, and I know about the cost of living being on the even year every 2 years. Can you speak a little bit about these police contracts that exist for police chiefs?
Yeah, they had individual contracts that for their stint as police chief, and the language in their individual employment contracts reference the management schedule of benefits, and management are eligible for a cost of living adjustment every year, according to there's like a elected official and department head salary and benefits guideline document, which talks about the COLAs every year. So that is where the language is for these 6 individuals in their employment contracts under which they retired.
So they're referencing the department heads
Mm-hmm.
document, and all 6 retire underneath that same document?
They all had an individual employment contract with that language about department head or management.
And no fire chiefs, I guess, huh?
Nobody's contacted me, but if you want to shoot me the names, I can look in their files.
I just got to make sure. And one further question. The 34 retirees that are currently paying medical cost share out of pension deductions, which group do they belong to?
They're across the board of the town groups, DPW, PETA, which is like the supervisory, the nurses, maybe not nurses, because they paid OPEB. I can't say with certainty nurses, but it's just town. There's no one from the Board of Ed on our healthcare, but those groups, it depends on the union they're in and the date that they retired, what their cost share is. So it's really all over the board for each person.
Good. And were they able to take advantage of like the Secure Act 2.0 recent federal legislation to provide them with tax-free status? Do you know if we're using that advantage?
No, their pension deductions come out after tax for their healthcare premiums
Got it. Okay.
of the pension.
Thank you.
Yep.
All right. Megan, thank you. Guys, if anyone else has any questions, we can absolutely follow up with Megan. By the way, I encourage you, if Megan doesn't mind, it's really, really great to, if you're ever here by town hall, schedule a time to sit down and just catch up with her. Super friendly, very knowledgeable, and really willing to just kind of just talk through things. I've found Megan to be really, really helpful. She really knows her stuff. So thank you. Chris, I'd like to move on if you don't mind.
Okay.
Okay. We've got some really good stuff this evening. I'm going to turn it over to Brian to kind of to take it from here. It's private equity night tonight, guys.
Yeah. All right. Good evening, everyone. This is Brian Binkley. Hopefully you could see me, but if not, I'm here in the room with everyone. So yes, as Carolyn mentioned, it's private equity night. So we've done this annual review the last few years, and I know it's been well received, and so we wanted to continue it. So we have really 3 things on the agenda. First up is Mark Andrew. He's on the phone. He's joined us in the past. He's a partner out of the Boston office. So many of you will recognize him or recognize the name. So he'll start this evening, and then after his update, we'll have Mesro dial in for their update, and then I'll join towards the, well, I'll speak towards the end as far as an update on performance and everything else. So, Mark, why don't I saw your name up on the screen. Why don't I turn it over to you? And thanks for your patience. And I know it'll just be a quick overview, but the team will certainly benefit from hearing directly from you.
Yeah, not a problem. Can you hear me okay, Brian?
Yes.
Okay, great. And it looks like you're sharing the screen. So I was going to say, again, I will be brief. I think this is probably a lot of pages. Keep in mind, we have to include all of these pages because we have SEC rules that we have to follow. But at the end of the day, all I'm going to talk to is about 4 pages. And I'm going to stop you right there on that secondary market leader slide. And just a reminder of what we do. Again, we've been around for almost 30 years now. We're one of the pioneers in the secondary market within private equity. And so when you think about what we do, think about private equity when folks like yourselves in large state pension plans, insurance companies, historically banks, they're committing to private equity. And when they're committing to private equity, they're signing up generally for a 10 to 12 year period with those managers that they're committing capital to. And what we do is, whether it's a change in strategy, we did a large transaction with CalPERS. We've done transactions with large university endowments. They have a change in strategy where they're looking for liquidity well before that 10, 12-year time horizon. And what we do is we come in and we buy their private equity interests. And again, we're generally buying things that are 4, 5, 6, 7 years old. We know what the underlying assets are when we're buying them. So we're buying mature private equity assets, and we're generally buying them at a discount to value. And so that's kind of our value proposition, is buying things at a discount to value, and hope we're backing high quality general partners that can drive value after we buy it. So when you think about our profits, think about 25 to 30% of our profit comes from the discount the day we buy it, but 75% of it comes from the appreciation of value after we buy it. And so that's why we're very much focused on quality managers. And I'll show you some of the underlying managers that you're kind of have looked through exposure to as we get further on in the presentation. So the one thing you should know is, you've committed to us going back to 2009. It's generally the same team. You can see in the first box here, 23 partners. We've been together for 18 years. So we've invested through a lot of cycles. So no real changes there. All you would have seen is significant growth in our firm. We're now up to 67 investment professionals and 160 employees across 8 global offices. So again, we've seen significant growth in our market. We've had little to no turnover. We have had a couple of folks retire as they've got up to 65 years old. They have retired, but it's the same team that you've backed from going back to 2009. And you can see here we have over 1,000 investors represented by over 40 countries. So again, we are probably the most experienced team in our industry. And you can see in our secondary performance, and I'm going to get specific on Fairfield, town of Fairfield, but you can see over a long period of time, we've generated 17% net IRRs for our LPs and 1.6 times multiples for our LPs. And that number is going to improve as some of our more recent larger funds mature. We think those numbers are going to improve. And you'll see specifically how town of Fairfield has performed. So with that, Brian, I was going to actually jump forward. I think it's page, hold on one second. All the way to page 22. And page 22 is going to be a summary of the commitments the town of Fairfield has made to Lexington. we have a large global secondary strategy. We're about to close on a $20 billion fund for that. But where Town of Fairfield has invested is in our middle market strategy. It's a smaller strategy. It's focused on the US. It's focused on middle market general partner relationships. And so here you can see the performance. And as I said, you go all the way back to 2009, you committed to that fund. In 2013, you committed to LMMI 3. And in 2017, you committed to LMMI 4. So in total, you can see over that period of time, you've committed $18 million. I'm going to go right to the total column just to kind of sum those up. But the good news is we've given back more than you've contributed. So you can see you contributed about 16 million. We've distributed back to you 20 million. So you've gotten back 1.25 times your money. And you still have significant value in our fund, $9.2 million of value. And with that, I dropped down to kind of the net IRR. It's generated a 17% net IRR. And it's generated a net multiple of 1.8 times your money across those three funds. And importantly, the 2017 fund in particular is still very young, so we expect significant appreciation of value from there. So I'm not going to say that you will have necessarily doubled your money, but you're going to come awfully close to having doubled your money on your investments with Lexington Partners. So anyway, that's kind of the summary of performance, and you can see, if we went fund by fund, the really mature funds, LMI 2, there's only $1 million of value there for Town of Fairfield at this point. It's a very, very mature fund, but it generated 1.9 times your money, and I think that's pretty much locked in. LMI 3 still, it's mature, but there's still, I would say, appreciation of value, what's left there. So I would expect that 1.8 times your money is going to get closer to 1.9 times your money. And then LMI 4, that's where there's still 3 million of value, and that's young. It's still, I think that's where we're going to see probably the most appreciation of value going forward. And so today it's only 1.4 times, but it will, in my view, again, based off of what I'm going to show you, some of the underlying exposures, that 1.4 times, I think we'll get up to that same kind of 1.8 to 1.9 times your money over time. And so with that, Brian, I was going to again hop forward, maybe just to give you a quick snapshot. Page 24, again, you still have $5 million, a little over $5 million of value in LMMI 3. And so these are some of the underlying managers that you would have look through exposure to. So these are, to me, high quality middle market and growth managers. So you see Metalmark is 16%. They're the former Morgan Stanley Capital Partners team. Again, we have a 35 plus year relationship with the Metalmark principals, long-term, really solid performer. And then you can see some of the other names. And for me in Boston, you can see Summit Partners and TA Associates are Boston-based firms, really, really high quality growth managers. But our whole strategy is a highly diversified strategy. So you can see we have some concentration in these top 10 names that are listed here, but there's also close to 40% exposure remaining across 53 other sponsors. So it's a highly, highly diversified portfolio. And then in LMI 4, and this is, I was going to hop forward, Brian, to just page 28. Again, here are the exposures here. Again, a lot of names that, I personally cover. Berkshire Partners, to me, is best of breed in the middle market. So we're really excited about the exposure we have there. The Jordan Company are some folks that I've known for 30 plus years over my career. And so we have significant exposure there. And so I think that's going to be, it's going to create significant appreciation of value. And so those are kind of the two top names there, but two names that I'm very familiar with where I think there's significant upside from where we sit today in LMMI 4. So with Brian, that's really kind of, I just wanted to give that flavor. I think we've performed really well for Town of Fairfield. I always love meetings like this, especially listening to Megan, because this is when I feel good about what we do, which is try to generate great returns. And the beneficiaries here for town of Fairfield, I think that's kind of the one thing I feel good about, for what we do for a living. So hopefully
Right.
You're pleased with those results.
Absolutely.
And I'm happy to
Thanks so
answer any
much.
questions
Yeah.
you may have. Yep.
Let's stop sharing.
Yeah, thank you so much, Mark. I know sometimes there's questions directly from the investment committee. Does anyone have anything directly for Mark?
So we can't see you guys, so if you want, just please, if you would, speak up.
Mark, what's the minimum commitment you make? You have you said there's like 53 other partners, it's 38% of the portfolio. I mean, what's the minimum commitment you make to these people?
It's again, we end up being a replacement LP for when we're buying them. Again, we're generally buying, so it's not necessarily a commitment, but we're buying the underlying NAV that's in the thing. We will do things as small as $1 million for things we know well, that we don't have to spend a lot of new time doing it. But in general, I'd say when we're buying exposures, it's probably somewhere between 25 and 75 million is probably the average bite size for what we're buying in these funds. So when that slide that's up on the screen right now, you look at Berkshire Partners, we have 155 million of value there. But you can see the parens next to Berkshire Partners, that's 8 different underlying interests in Berkshire Partners. So we've purchased interest in Berkshire Partners on multiple occasions, but on average, it probably is somewhere in that, I'll call it $50 million range of what we're doing for things like that.
How do you originate these secondary sales? Do you go out
Yeah,
and
some-
get them, or-
Yes, in the middle market, a lot of it is the GPs themselves coming directly to us. We have this long history. We have long-term relationships with all of them, but there are, I'll call brokers or agents in this business. So, I mentioned we bought $2 billion worth of product from CalPERS, for example. And by the way, CalPERS is not reducing their private equity allocation. They're just trying to create room so they can continue to commit in the future to private equity. They sell down some of their older exposures, but those large fiduciaries like that, they have to hire an agent to go out and canvass the market. So for something like CalPERS, that's a $2 billion portfolio. There's not many people in our industry that can write a check of that size, and we can. Now, again, the middle market thing's a little different. There's less agents involved, but there still are. These names might be within a broader portfolio, but we just happen to put it in our middle market portfolio because it's a fit for what we're doing.
Thank you.
But it is, again, just the only thing I'll say is it continues to be a competitive business. We have to compete every day. So.
Mark, I had a quick question about you mentioned CalPERS, having a strategic change of direction that makes perfect sense. Do you ever get involved in what I'll call special situations where the asset is subperforming and you're coming in because of expertise in whatever, a middle market discipline where the owner doesn't have that expertise and doesn't quite understand that things could be better than they appear? And on that point, if there's a discount involved, what would be the typical range of a discount?
Yeah. And sorry if there's an echo. I feel like there's a little echo when I'm talking here, but we don't really get involved with special situations like that. We're not looking to buy distressed type companies. That's not kind of what we do. We're buying a portfolio of funds, generally well-performing funds. Again, a typical fund, let's say, has 10 to 12 companies. We can identify which ones out of those 10 to 12 companies, there's probably 9 of them that we view as value drivers, and there's 3 of them that we think are probably not going to increase in value over time. So we're underlying each of those underlying assets. So if there's an underperforming thing, typically we're not putting a lot of value in those underlying things. And then the discounts, again, it changes over time. I would say right now in this environment, again, this is very specific to middle market type companies. I'd say the discount's probably in the 15% range for middle market funds right now. Now, again, you guys are not in our global secondary strategy, but our global secondary strategy gets involved with venture funds. That's about 15 to 20%. So if I'm buying a venture fund today, it's probably a 45 to 50% discount in the venture world because they have some particularly high valuations that they're carrying those companies at. So, and we tend to solve for a higher return when there's venture involved because of the higher risk. But that's where the large discounts are. But I will say to you, like, again, the middle market is even more is more relevant here. Is the discount is important because it provides a nice buffer for us if there's a downturn in the economy. But at the end of the day, we're generating most of our return on the appreciation of value after we buy it. And so that's why I try to hammer home. Again, you guys might not be familiar with those top 10 names that I talked about, but those are all really high quality general partners that we have long histories with that are really top performers in private equity. And that's where our focus is on. It's on more quality than it is discount, particularly in the middle market funds.
Can you, Mark, can you talk a little bit, we're in the 2017 fund, and the older funds, obviously. Can you talk a little bit about the exits, particularly kind of in light of the fact of the kind of the current market conditions that haven't necessarily been all that conducive to exits?
Yeah. So no, it's a great question because look at the funds have long lives. Now, I'll look again. It's not on the screen, but if we went back and we looked at the old one, the first one you did with LMMI2, that goes back to the 2009 vintage. We've been, we invested it over probably a 4-year period. But these funds have long lives, so they hang out there for a while. But I would say for us on LMI2, we're getting to that stage where it's, again, for you guys, you're down to 1 million of value. You've made 1.9 times your money. You've gotten already back 1.7 times your money, and it's generated a nice IRR. We are probably getting to the stage that we look at that underlying value and say, you know what? We don't think there's going to be a tremendous amount of appreciation and value for here. So we will in turn sell that to another secondary player who kind of specializes in, I'll call it, old tail end funds. And that's what they like to do. They like to buy some of these old, call it fund to funds type vehicles like an LMI2. I think we're probably a year or two away from that on LMI2, and we're probably 5 years away from that on LMI3. But that's that we've done that in the past. Again, you're not in our very first LMI1 fund, but that's what we did a couple of years ago on LMI1 is we sold it in the secondary market. So that's our path to exits. We don't control the exits on the underlying funds. That's really the GPs that are controlling those exits. But that's the one way we can control the exit. As this gets old, we'll look to do our secondary transaction ourselves.
Thank you.
Perfect. Yeah, thanks for all the questions.
Thank you very much. I know this is a short amount of time. You squeezed an awful lot in, and very much appreciate it. This is the one thing about kind of the period of time that we've come through with the pandemic is it allowed everybody to have the ability to remote in, and so we're very, very appreciative of your ability to attend the meeting with us this evening without having to schlep down to Fairfield. So thanks so much.
No problem. And if you need me in person, I have no problem schlepping down to Fairfield. So
have a great evening.
Thank you, Mark.
Right. We'll see you. Thank you.
Thank you.
Okay. Okay, I saw that, so that was a helpful review, and I saw that Courtney Hayes is on the line from Mesero, and that's a name you probably recognize from previous years as she's joined us. She's one of the senior managing directors. Good to see you. Just popped up on the screen, Courtney. And I know you're joined by Mike, if you wanted to do an introduction. And yeah, thanks for your patience as we got started here today.
No worries, no worries. So hello to the Town of Fairfield Board and Brian. It's nice to see you all, and thanks for inviting us to share an annual update with you. So again, I've met some of you. I'm Courtney Haynes. I'm responsible for investor and consultant relations at Mesero Private Equity, and I'm joined by my colleague Mike Elshire tonight. And the two of us, our goal is to give you a comprehensive, detailed update on Mesero, the firm, your commitments to our Fund 6 and 7A today. So first and foremost, I would just thank you for your support and partnership. We appreciate it. And why don't I dive in? Thank you for putting the presentation up there. I can jump to, let's see, slide 3 here, or let's go to slide 4. Thank you. Really, I hope that you've come to know Mesero Private Equity since we started working together. I think your initial commitment was in 2012, but to give you an update on where we are today in July of 2023, we're at about 6.6 billion in AUM. We raise most of our assets. The majority of our assets come from our flagship fund-to-fund program, which is where you have your 2 commitments in Fund 6 and in Fund 7. We also raise dedicated co-investment funds. We're launching our first secondary fund, and we have a couple separate accounts. But what I hope you've come to appreciate about us is that we are a focused, boutique-sized private equity fund-to-fund manager, and we are really proud of the strong history of outperformance that we've been able to generate for our clients, and that's across strategies and across kind of disciplines, so across the primaries, the secondaries, and the co-investments. We are really intentional and focused in raising assets to match what we believe is the best opportunity set in the environment. So our fund of funds are somewhere, sub 1 billion in assets. And we think that allows us to best position ourselves to kind of pick the cream of the crop. And we're committing to about 10 GPs per year. We'll do selectively, 5, 6, 7 co-investments and secondaries on an opportunistic basis. If you wouldn't mind flipping one page forward, I'll just highlight the team here. Thank you. We are headquartered in Chicago. We believe we're in a hybrid situation as well. So it's nice to be able to join you guys by Zoom, but we're also happy to do these in person. Our team is together in the Chicago office Tuesday, Wednesday, and Thursday. We tend to be remote Monday and Friday, but business needs sometimes brings us together in the office, which we like to be together. On the left-hand side of this slide is the investment team. We're really proud of the depth and breadth of experience here. You have senior leadership by folks like Mark Sachs and Tom Galoon, who have spent 3 decades in this industry, and partnering with Bob DeBolt, Ryan Vedrunch, and Christina Pierce. These 5 represent our investment committee, and they've been the investment committee that's in place working on behalf of you all. And they're supported by a great team of VPs, associates, and analysts. Mike and our job is to be a resource to our clients and our consultants. So please don't ever hesitate to reach out if we can help in any client service related way. That's what we're here to do. And we also work with our colleagues on the accounting and operations team, on the legal and compliance team. And maybe the only other important point to note on this slide, and you probably remember this over the years of knowing us, the benefit of us being a part of Mesero as our corporate parent and the broader organization is that our team is focused exclusively on private equity. So whether you're focused on investments or investor relations, and then we leverage Mesero for all of the other important ancillary services that are necessary to run our business. So let me dive into performance now, if you wouldn't mind flipping forward another slide, please. Again, I mentioned that we're really proud to have delivered consistently strong outperformance for our clients. What I'm showing you here on this slide is our fund-to-fund track record going back to 2001. You can see the net IRRs on the left and the total value to paid in capital multiples on the right. You all have exposure to our Fund 6, which is a 2013 vintage year fund where you had a $15 million commitment, and Fund 7A, a 2017 vintage year fund where you made a $4 million commitment. We're delighted to be able to deliver this performance, and we appreciate your support. We think for a fund-to-fund to have the power and ability to generate a net IRR of 18+%, 21% is pretty meaningful, and it's important to us as well to generate multiples on invested capital. So our goal is to exceed a 2x net multiple. You can see in Fund 6 we're above 2.5 times right now. Fund 7 approaching that goal for us, and confident that we'll get there. You can see on this slide, we're showing our loss rates on invested capital. This is something that we're really, we pay particular attention to. So a loss rate on invested capital of about 1.1%. This is a key metric our investment team uses when they're diligencing managers, and we like to kind of reverse that lens and look at ourselves as well. I want to give you a really detailed portfolio update, and Mike's going to do that today. So maybe if we could flip to one more slide. The next slide here, slide 7, does show our core co-investment track record. I'm going to skip through this given that your exposure to us is in the fund of funds, which is primarily primary partnership commitments with an opportunistic allocation to secondaries. Since the time that you have committed to us, we made a slight shift in the way we raise capital. We always raised a dedicated co-investment fund alongside our fund of funds, and most of our clients accessed both. And we got a lot of market feedback that having one vehicle, which included primary, secondaries, and co-investments, made a lot of sense. That's what we do today. We're proud of the core co-investment track record, but in the interest of time, I want to skip by that and move on to, I think it's 2 slides in here. Slide 9, let's talk about Town of Fairfield's performance. You can see we've aggregated it here, $19 million in total commitment to us. Distributions to date, this data is as of 3/31. Distributions exceeding $17.5 million, a net IRR to date of 20.9%, and a TVPI multiple of 2.4 times. Mike is going to give you kind of a detailed look at that performance. So if we could flip one more slide here, I'm just going to do a high-level overview or more of a reminder for you all of the investment strategy and our portfolio construction goals. Thank you so much for driving our slides. But really the goal here is, as you probably well know, we provide kind of core diversification. You can see it illustrated on the bottom of this slide by manager, by vintage year, by sub-asset class strategy, and then by transaction type. We're really designed to provide exposure to the best US focused, we have a bit of non-US, but primarily US focused private equity managers raising capital across the private equity spectrum. So buyout, growth equity, venture, and special. We think kind of committing capital over about a 3.5 to 4 year investment period makes sense. You get that 4-year vintage year diversification. And I mentioned this earlier, but our emphasis is on being incredibly rigorous and disciplined in the investment process and being highly selective in investing with the cream of the crop. So I'm going to pause and turn it over to Mike, who's going to give you more of a detailed look at the portfolio.
Thank you, Courtney, and it's great to meet you all. I don't think we've had the chance to meet yet, so thanks for having me. If you go to the next slide, I can start with the Fund 6 update. Thanks. So Fund 6, 2013 vintage fund of funds, about $650 million in fund size, with 25 underlying managers, which equates to about 40 different funds within the portfolio. The portfolio is 89% drawn. It has a TVPI of 2.6 times. This is pretty rare for a fund of funds to have a performance of 2.6 times. This is a first quartile fund, excellent performance. You can see the performance in the middle of the page there, 21.2% net IRR for Town of Fairfield, well ahead of the private equity fund of funds benchmark, as well as the Russell 2000 PME that we have on the page of 10%. So getting to Town of Fairfield.
Sorry to interrupt, but what's the plan for the fund from here? That's a 10-year-old fund. It's a first quartile fund. I mean, it's been a blockbuster. Congratulations across the board. Congratulations. But where to from here with this?
Yeah, so we're kind of like in the middle of the harvest phase. So I would say we're kind of in the middle of distributing capital back. So you can see on the top right the vintage year diversification. So these are the commitments by year to the underlying funds. So this one all the way until 2018. And so each underlying fund typically has about a 10-year term, sometimes using extensions to go to 13 plus years. And so, I think we're in year 10. Our term as a fund of funds has a 12-year term, and we have 3 one-year extensions. At this point, I would assume that we'll use those 3 one-year extensions, probably get to about year 15, and hopefully by then the fund will have naturally liquidated all of the underlying positions. That's always a dynamic situation with the underlying market. As we've seen over the last year, markets in the public markets and private markets have dried up a little bit. And I think, over the last 6 months, we've seen more, positive performance in the public markets and the stock market, and that has, driven some underlying distributions. And so, as long as, the market, the overall economy is going up and to the right, I think that will enhance distributions and get to the fund life of about 15 years.
Okay.
I had a quick question about the financial side of things, financial markets side of things. Are you seeing any effect from the regional banking crisis, I'll call it, on the companies that you invest in? I guess I don't mean the portfolio companies necessarily, but also the actual funds that you invest in.
Yeah, so a number of, sorry, could you mute? Thank you. So a number of the funds that we invest in used SVB as their banking partner. And so as they were kind of going through the SVB crisis, they were sending continuous updates on the status of, where their money was, which portfolio companies were using SVB as a banking partner. And so we were getting continuous updates, and we did not have any money that was at risk or that suffered from the risk of the regional banking crisis. Continuing into, I'm trying to remember the names of them. First Republic, I believe, was one, but we did not suffer any downturn from that.
Thank you.
Sure. So continue on this, on Fund 6, in terms of Town of Fairfield's investment summary. So as Courtney mentioned, the plan they committed $15 million to Fund 6, of which 13.4 has been drawn, about 89%. Fund 6 has delivered $17.5 million back to the plan as of the current date, and still has about $17 million left in NAV. If we turn to the next slide, I can talk about the drivers of performance and what's really helped get to the 2.6 times TVPI. On the left, we have Meritech 5. So Meritech 5 is a late-stage venture capital manager. They're out of California, a really, really strong late-stage venture capital firm. Back in the day, in the early 2000s, they invested in Facebook and made, I think, 50 times their money. One of the early Facebook investors. This fund, Fund 5, has a 53% IRR and a 7.6 times TVPI. The big driver of performance in this fund is a company called Roblox. And if you have kids or grandkids, they're probably playing Roblox. It's a gaming platform that is very, very popular. And that investment returned 45 times capital. So very strong. Next, we have Thoma Bravo 11. Thoma Bravo is probably, in our opinion, the greatest software manager in the world. They have a track record of high quality performance, first quartile performance going back 20 years. This fund, Fund 11, has a 3.4 times TVPI and a 27% IRR. And 11 of their 14 companies that they invested in have returned over 2 times. So they really did not miss in that entire portfolio. Pretty rare to have a success, throughout the portfolio. And lastly, we have Spectrum 7. So Spectrum is a growth equity and growth buyout manager. This fund has a TVPI of 4.1 times and a IRR of 38%. The big driver in this portfolio was a company called GoodRx. So which is a company that if you have a prescription from CVS, let's say, it will allow you to see the price of that prescription at CVS or at Walgreens and compare the prices and be able to figure out where the cheapest place is to get that prescription. Lastly, these 3 investments on this page have distributed over $200 million in distribution back to Fund 6 on just $61 million of invested capital. And they still have $74 million in NAV. So these 3 investments have been spectacular. While we have seen performance across the board of Fund 6 be spectacular, these 3 are really the shining stars. On the next slide, I can touch on Fund 7A, excuse me. The Fund 7A is our 2017 vintage fund of funds, about $650 million here as well, 27 underlying managers. In this fund, we've drawn 78% of capital. So you can see in the investment summary, $3.1 million has been contributed to the fund of the commitment of $4 million. Distributions have just started in this fund, year 6, which is right on track with kind of how we pace these funds. It has an NAV of about $5 million. We're at the point in this fund where contributions and distributions start netting each other out. It's possible that we could do one more capital call of about 1 to 1.5% in Fund 7A, but I would imagine over the next 6 months or so, we should start seeing distributions outpace contributions, and then it'll just be cast back to the plan. The net IRR in the middle of the page, 18%, well ahead of the Russell 2000 PME here as well. You can see the underlying managers there at the bottom. You're going to see a lot of similarities between these names and Fund 6, as well as our current fund, our most recent fund, Fund 8. We typically cycle through maybe 20% of our managers to keep some fresh blood in the portfolio. Some new managers in Fund 7A were HIG, New Mainstream Capital, and EMK. So these are all more middle market focused managers where we think have the best risk return. On our last slide here, on the next slide, we have the drivers for Fund 7A. So these, on the next slide, thank you. So Fund 7A is 2017 vintage, so we're starting to see kind of the portfolio blossom, and some of these funds are starting to really show performance. So one being Silversmith 2. Silversmith is a growth equity manager out of Boston. This fund currently sits at 2.8 times TVPI and has an IRR of 45%. Thoma Bravo, which I had mentioned previously, one of our favorite managers, has a TVPI of 1.7 times and a 30% IRR. The big driver in Thoma Bravo was so far is Ellie Mae. So Ellie Mae is a mortgage origination software. We were lucky enough to co-invest alongside Thoma Bravo in this deal, but they returned 4 times their money in 18 months. And so it was a really quick, really awesome win for the portfolio and for Fund 7A investors as well. And lastly, we have NewView. So NewView is a unique situation. It's a secondary where they spun out of NEA, which is a venture capital firm, and they purchased a portfolio of companies from older NEA funds. So you can see NEA funds 12, 13, 14, and 15. So we got that at a discount, about 8% discount. We were investors in NEA funds 12 through 15, so we knew these companies really well. And so it was an easy due diligence for us to understand that this was going to be a highly successful secondary. And currently it's valued at 2 times. It has a 22% IRR. The winner so far in that portfolio is a company called Duolingo, which is an app that allows you to learn a new language. So that's our update for Fund 6 and Fund 7A. In the appendix, we have some information on our latest co-investment fund. I don't need to go through that with you, but if you have interest, please feel free to flip that, and we can schedule time to go through that at a later date. But if you have any questions, I'd be happy to take them.
Can you, and everyone, please feel free. We can't see you. Maybe we can stop sharing. Jared, stop sharing. The question I have is just one on performance, which has been great. But one of the things that has been interesting to see was the drawdown in performance wasn't as, we didn't see a performance lag as, the performance wasn't as negative as we had feared it might be during the last kind of several months, right? As we see performance numbers that lag kind of the equity returns by 3 months. And we just figured it would kind of follow the equity market by 3 months, and it followed, but it wasn't as sharp. And I'm wondering if you can kind of help put some context and color on that as to why that was, and give us a little sense of kind of what we can expect to see kind of performance-wise, what you're seeing out there in general, and how these portfolios are being marked.
Yeah, sure. So in terms of the muted response of the private markets versus the public markets, part of that is just because of the lag in reporting. The public markets are priced daily, whereas private markets are every quarter. So that's part of the reason. The other reason is because these private equity managers are able to be hands-on with these portfolio companies, and also help kind of sustain and keep valuations either flat in down markets. I'm trying to think of what your other question was. Oh, go forward.
Yeah.
So I think we're optimistic about the go forward economy. I think we did see rates increase today. However, the Fed has made indications that that's not going to happen for the long term. And so if rates kind of settle in, I think that our portfolios will perform nicely. And I think that's kind of the general case. So the exit markets and the private markets do follow some of the public markets. So when the S&P 500 is increasing, you're more likely to see IPOs. You're more likely to see M&A activity. M&A activity is really correlated to how interest rates, what interest rates are. So if interest rates are high, companies, private equity companies are less likely to borrow to get these deals done. And so if we start to see rates come down, settle or come down, I think we'll see more M&A activity, which should drive distributions for Fund 6 and Fund 7A.
Thank you.
Yeah.
Anyone have a question?
I got a question. Going back, like with obviously some of these are how much leverage are on the portfolio companies? Is there much leverage, and if so, how's that impacting the operations of those companies given the rate increase?
Yeah, that's a good question. It depends on the stage of the company. So if you look at venture capital or growth equity, they're not really using any leverage. On some of these large buyouts, you'll see leverage of, there will be 4 times debt to equity. And I think our managers in particular, I can really only speak to our portfolio, they were very cautious to take a lot of leverage as we saw rates really increase. And so, being cautious and really not doing a lot of deals as we saw rates kind of skyrocket has really helped our portfolio succeed. So, I think our selectivity has kind of shown it that this is kind of the way to build a portfolio. And it's been really successful so far.
Bruce, did you have a question?
I'll pass. Thank you.
Okay.
Good. Courtney and Mike, thanks for joining us this evening. I think this is perfect overview as far as the 2 funds, and it's always good to get the questions too as far as just the outlook of what you're seeing as well. So, I mean, if there's any other questions, yeah, definitely please jump in or.
Thank you.
Thank you all. We really appreciate the opportunity to share an update. You guys always ask really good questions, very thoughtful. And again, thank you for your support and partnership. We appreciate it.
Yeah, thank you guys.
Thanks.
Been great
Have a
to
good
get-
night.
Thank you very much.
Enjoy the rest of your summer.
Thank you.
Bye-bye.
Okay.
All right.
Yeah, so we could,
Back to our lead pony.
all right, we can move over to the Vanguard side, and part of that will be looking at some of the private equity results.
Yeah.
They're still through the first quarter, we don't have the second quarter performance yet for the private equity managers. We do it in the total portfolio.
But what stood out to me, I don't want to get in a long
Yeah.
conversation. It seemed to me like, obviously in the last year, 2 years, especially in the last one, there's been lack of commitments.
Yes.
And they're all probably sitting on their hands.
Uh-huh.
And Carolyn started down the valuation pact, which I've brought up a couple times. Because
Right.
I think those things are questionable. I'm not,
Right. Right.
Who's marking these things? And again,
Right.
I don't want, these are hard questions.
Right.
Which require a lot of due diligence
Right.
into every single piece of the portfolio.
Right.
And there's no way we're going there. We have to rely on these people.
Correct.
And one of the things that stands out as like any manager, if you're not doing anything, you're getting paid for doing nothing.
Right.
I'm sitting here getting a fee on an annual basis to be looking at markets where there's little to no liquidity, and opportunities are. I'm afraid at this point. Everybody is.
Right.
And so it's a very difficult. I mean, I'm not questioning. Somebody has to make that decision.
Correct.
Right. And I think that we sit here and we're relying on them to do it. And when you start asking the duration of how long is our money going to sit here?
Right.
What if this goes on for another 5 years? And there's distributions are.
Right.
They're not 5% like we could get in money markets right now. I mean, it's interesting. And what kind of real discount would they have to take if I want out? What's the distress number for, a piece that's left?
Right.
50% discount? I don't know. I mean, I don't see enough of that. I have seen enough. I've seen some companies go 80% discount in the private equity world.
Mm-hmm.
You know, and big pieces of, and because businesses that looked like they were going to thrive, all of a sudden in the new world, they're not thriving.
Mm-hmm.
And there's just too many questions. And I'm not even sure what the question is to them, except, you know, continue to do the job you're doing. And the longer that money stays there, an 18% IRR starts to, without any real, you know, those numbers look good. Those numbers look good, but they're not real good. And when you consider 10 years, 2 times your money.
No, did you see that? Did you go, and you start thinking like.
A 7% return on your money.
Right.
All right, that's all. It's not, you know, and to have a liquidity, what it does is it gives us a diversification that we all need. You have to. If you don't, then you're not being prudent with, as a fiduciary to say, look, I don't know.
It's another layer of diversification. It's active equity, right? In its most aggressive form, right? And you could do active equity as the long-only manager. The private equity returns, if you have a high-performing manager, have outperformed the public markets.
Yeah.
Like there's plenty of studies, and we've done them before going into private equity as well, and HarborVest can confirm. But if you're with the median manager, you're getting equity, you know, public equity-like returns.
Right.
If you're with the top managers, they've certainly over time have outperformed in certain degree in certain instances by a large degree the public markets. So it's
Yeah, but we just saw the first quartile number.
Yeah.
We just saw those numbers. We're in one of those funds. We actually have the math.
You do have less transparency.
We have the numbers.
Yeah, there's no question, but the returns have been beneficial to the town over those longer periods of time.
And what we're here about is not just yesterday.
Right.
What counts is today and tomorrow.
Right. And so it's a tough period because, and there's some slides that I put into the presentation directly from HarborVest, but you've heard other HarborVest talk about it, is still committing, you know, still being regular commitments to private equity, and in these tough times, because that's when some of the best returns that the private equity managers have realized is in those distressed times.
Right.
It's hard, and you know, I think the natural reaction is to want to pull back, but at the same time, even if you look at the HarborVest returns, you know, you can find some of the best opportunities during that point.
But you know, you as the investor, we don't get to determine when the capital goes to work.
Right.
We get to say, we get to wait for the capital to be called.
Correct.
And so that, to me, that feels a little disingenuous.
Yeah.
Because I make a commitment, but then I wait for you to find something and say, oh, remember that now.
Mm-hmm.
And so I feel like we're still waiting on the first HarborVest fund. And so shouldn't we be getting capital calls all the time right now? Like, these have been the bad times, right?
Yeah.
We should be getting calls left and right.
Well,
So
the question is that's an interesting,
Yeah.
I don't know the answer to this, and that brings up a question. To make a commitment, let's say HarborVest was it 10 million, 20 million? I'm not sure what the number.
Yeah, we've done two so far. We've done 30 million 2 years ago, 25 million last year, and then this year, assuming we still continue the pacing, would be 15 million. So the amount is coming down. The reason we're higher in the beginning is to try to get to that 10% target allocation.
Is there and a small percentage that has been invested, like
Correct.
I don't know, 10% less. I'm not even sure.
Right.
So where is the money? Is it in our hands? Are we earning a risk-free rate of return on that money?
Yes, it's still invested in the broader portfolios because it's been committed,
So
but it hasn't been called.
they're managing the cash. We gave
No, the funds are still here. They only go there when they do calls,
Okay.
and there's only been a few calls.
So we have 40, let's say, you said 20.
Majority has not been called, an overwhelming majority,
Like,
so,
how much has been called, 10 million?
no, less than that.
3 or 4 million, I think was the last time I saw something.
Yeah, so it's all in there,
So
but,
so there's 40 or 50 million
Out
dollars,
there waiting.
and we have that under, in our
It's in the,
war chest
it's in
somewhere?
the equity.
it's
the equity
invested
Oh,
in the greater
we're
portfolio.
gonna pull it out of
Uh-huh.
the equity market when they make the call.
Bingo.
Okay,
Correct,
all right.
correct. Yeah, it's not sitting in cash,
Okay,
yeah.
I don't know where the,
It's-
the float is here.
Right, right. Well, let me maybe just stay on.
Sorry, I mean.
No, not at
Yeah.
all.
Yeah.
We want to get the questions.
But we will get to a point where we'll have to make a decision.
Right.
This board will have to vote whether or not it wants to make another allocation decision toward, an additional allocation decision toward private equity.
Mm-hmm.
Well, at 55 million, that's roughly 11% of the portfolio, is that about right? What is the portfolio?
The portfolio right now is 400 and, as of 6/30, 433 million. Yeah. So it's a matter of, and we'll come to that, and we'll look at the pacing in the sense of, you're making commitments, it takes time to get in there to return, and then you get the distributions. And so you're constantly looking at the calls versus the distributions, and you'll never get the allocation perfectly right on your target because just of the nature of private equity. But some of that pacing data we continue to show, and it's in this presentation as well.
Okay.
Mm-hmm. But I just wanted to maybe stay on the private equity, just high level, real quick, and to that point, because you bring us some points that are worth hitting. So one is, you're right, so PE, private equity deal volumes year over year are down 59% from where we are, and I think that's in light of the economic environment, the interest rate environment. These are high-level bullet points. Secondary discounts, are remaining elevated. That's directly from HarborVest. You heard a little bit from them, but so secondaries is like, okay, we need liquidity, we want to get out, we're over-allocated, or we want to commit more in the future. So secondaries is like, okay, I want to sell my stake, and HarborVest or Mesirow will buy that stake. So the discounts that HarborVest is seeing are elevated. I don't have a specific number, but I guess more than usual.
The guy at Lexington was saying that they're buying,
Invite others into the conversation.
I think he said his discounts were only like 15%.
Yeah, for middle market opportunities, and then higher typically for venture.
Well, venture, he said distressed stuff was 45 and 50%.
Right.
Which is probably realistic.
And then also they're seeing just more opportunity in co-investing alongside one of the general partners, because the IPO market has been pretty lackluster as well. And so HarborVest are seeing more opportunities to co-invest, say, alongside with the Thoma Bravo or any one of the general partners. So that's kind of the high-level market environment that they're seeing as far as those three things are concerned. I mean, I don't think that's that different from when Matt was here the last meeting 2 or 3 months ago, but that's on par. And then speaking of capital calls, they are accelerating their capital calls in this environment. So we don't have specific, what we do know is that they're going to call capital in the third quarter and the fourth quarter, probably in the range of 10% of the committed capital. So we're expecting a capital call for the 2022 fund in around the August 10th timeframe, but we don't know the exact dollar amount. So we've left some extra cash in the portfolio right now just because we got contributions recently, employer contributions that came in only like a week ago. We left some in the ballpark to anticipate that capital call. So HarborVest is expecting to see accelerated capital calls just in this environment. They haven't to this point, and they've used credit lines to invest a little bit, but we will see that pick up. That's been kind of telegraphed from HarborVest.
Good.
Mm-hmm. Yeah.
What is the policy guideline that we put in? Is it 10% or 15%?
10%. 10% to private equity.
Okay.
Yeah. So, yeah, I'm glad to jump around, but do you want to jump into the bigger picture with the portfolio and then come back to private equity?
And hey, guys, you know, I don't want to exclude you from the conversation. You know, we can't see you when we have the screen up, but I also want to make sure that we're sharing our screen with you. So you tell me, those of you on WebEx, would you prefer that we share the screen, share the slides, or would you prefer to look them up on your own screen, and we just kind of allow you to view us?
I would vote, this is Tom, I'd vote for having the slides on the screen. It's just easier to follow. Sometimes people say move ahead, and it isn't clear to me which page number exactly we're referring to, so that'd be great. That'd be my vote anyway.
I concur.
Okay.
All right, so just because we can't see you well, we're not gonna see you if you have your hand raised physically, so just jump in, I guess, right?
Yeah, just
When you-
jump in.
If you have anything to add.
I'll be sure to pause, but also take your cues. So with regards to the presentation that I have pulled together here is reviewing performance through the end of June. So I'd review the capital markets at a high level. We'll turn to the performance of both the pension and the OPEB, and then I did include some pacing material on the private equity side. So it helps, like, you know, I always I can alter my time any which way. What would be a good time to get through the material? I never usually go long, but what would tell me pace on how quick I should get through everything? And I'll know where to.
3-4 minutes?
Okay.
I
My
think,
dinner's getting cold.
Yeah. All right.
Go ahead.
let's go. Let's
Yeah.
just go through it. Let's go through what you have, and
Good.
if you see us falling asleep, we'll
No,
go quicker.
that's good. And I also have my colleague, you'll see Clark on the phone. He's out of our Arizona office. Brian Scott.
If you guys aren't talking, you should mute your phones. That's where we're picking up the echo from. Thanks.
Brian Scott is a name that you saw in the past, so he took a promotion within our manager research group. So I share that with some of you. So Clark I've been working with Clark for over a year, but he just joined the towns kind of as another contact on the portfolio supporting me in the town a few months ago. So he's on the line today. So I'm going to call out the pages, even though we have it up on the screen. This is page 4, and this looks at a high-level view of the markets, and I think it's very relevant it is very relevant to the portfolio because within the town's equity and fixed income portfolio, the public markets, we are indexed, and so those investments are mirroring really what you see on here, which are the broad market indices. On this page, you see the second quarter, you see calendar year to date, and the 1 year. The 1 year, of course, is your fiscal year. So with that said, I mean, coming into the year, I mean, who would have thought that returns would have been this strong, right? With everyone, you know, with interest rates where they are, with everyone calling or expecting a recession, you know, this is why it's so hard to time the market. You don't know when it's going to lead and by how much and what's going to happen. And so this is just another testament to this. So if I look at the year-to-date numbers, which is that middle column, the dark green, U.S. equities up over 16% year-to-date. Non-U.S. stocks up still a strong 9%, but behind U.S. stocks. Predominantly why I think they've lagged, because that was reversed, you know, only like 6 months ago, is, and I included some slides in this presentation about that, is the narrow leadership that's happened in the U.S. equity market from continued from the tech names, and then a lot around this artificial intelligence, AI, some names like NVIDIA, et cetera. So U.S. indices have a much higher allocation to the IT, to the tech sector. So in the U.S. market, tech makes about 30% of the market, whereas in overseas markets, it's about 20%. So I think that's leading to a lot of the dispersion. I mean, strong returns either way, but that's explains some of the laggard behind the non-US stocks. Non-US stocks that have a much bigger weight to, say, financials. So strong returns there. If we go to the fixed income section in the middle of the page, on a year-to-date basis, even though rates have gone up, especially on the shorter end of the curve, we still have positive returns from US bonds and from non-US bonds. So you see US bonds up over 2%, non-US bonds up over 3%. And that's partly a result of just the higher interest rate environment that we're in. Even in a rising interest rate environment, they've still been able to put together positive gains. On the one-year basis, which is the yellow line, so because of last year, which, you know, was historical loss for fixed income, so on a US bond side, negative 0.8%, and then non-US bonds hedge, which we have, was up slightly, so up 0.4%. So starting to get some positive returns from the fixed income side. I'm going to go through the next two slides pretty quickly, but since I hit on it, I just wanted to show it to you. So on page 5, it looks at the different segments of the U.S. market. It's led, you know, the year-to-date returns have really come from the larger cap companies. Mid and small cap, you know, the returns are still fine, but it's the larger end that's performed well. And if you see the big column in the middle of the page, it's the growth stocks, again, that have rotated and have done particularly well on a year-to-date basis, but even on a one-year basis.
Oh. Oh.
And then page 6, this gets to what I was talking about as far as maybe the narrow leadership. So the 10 largest companies in the S&P 500 have contributed 74% of the return. So the left-hand bar shows the top 10 stocks, you know, which make up about 30% of the S&P. But on the right-hand side, you know, the contribution has mainly come from those 10 largest stocks. And then you'll see names you're all familiar with, but Apple, Microsoft, NVIDIA was the one I mentioned. I think it's the best performing stock within the U.S. market, almost up 200% on a year-to-date basis. Facebook, you see Tesla, Google. So page 7, the next slide, just one other way of looking at this. This is the distribution of returns for the S&P 500, and just kind of saying on the far right, you know, only, you know, less than a third of S&P companies have outperformed the broad market. So it's really it's hard to find which stocks are going to, you know, perform and how much they're going to outperform by, and that's what makes active management, you know, very tough, you know, for some of the active managers. If you didn't own those big names or are overweight, you're likely underperforming. And I'll skip over 8 and 9, but it's just data if you're curious about, you know, the weights of those companies and the best performing stocks. So I'm skipping over those slides. On page 10, this is just still looking at the yield curve or the interest rates along different maturities. So the yield curve still is inverted. The inversion from the 2-year bonds versus 10 years have been inverted for over a year now. If you looked at more of the 3-month and 10-year inversion, that's been since October. So that's always in the news because it's usually a precursor to a recession, but it's you know, it's kind of well telegraphed here. So let's move into the actual pension and OPEB returns. And I'll look at that. I can cover any period, but I'll look at that 1-year return because that's the end of the fiscal year. And so you'll see at the top of the page a strong absolute return of 7.59%.
It's a very exciting number.
Yes, yeah. It didn't quite erase the gains from last year's because I went back and looked at where we ended up 2022 fiscal year, and the portfolio was down 8.88% for the pension, but still a mighty strong reversal.
You know, the discount rate.
Yes, well above the discount rate.
6 months.
Excuse me?
Wow.
Yeah, not here because we can only show either fiscal year to date or calendar year to date, but I'm glad you asked that, Bruce, because I wrote that down. So on a calendar year to date, which is not on this slide, the portfolio is up 7.6%. That's versus the benchmark of up 8.6. The OPEB portfolio is up 9% on the first 6 months of the year, calendar year to date, and that's really even with the benchmark.
Right.
So still strong in the first 6 months of the year. The underperformance, and I'm going to touch upon the underperformance, say if you look at the 1 year basis, 7.59 versus the composite benchmark of 8.5, why are we underperforming? That's really on the private equity side, because they're lagging the public benchmark over the 6 months or the 1 year basis. That also was a big reversal, and I'll touch upon, from where we were a year ago. So, the private markets, they lag, but they're not immune to what's happening in the broader markets. So it's just, you get the diversification where they were really strong last year when the public markets weren't, but eventually, they do have to somewhat to market. We're within all of our policy targets. I mentioned, this is in July, but we did get contributions for both the employer-employee of over $12 million. At least in the pension plan, but we have distributions on a monthly basis over $2 million going out as far as pension payroll. So we use that to rebalance. If we go to the next slide, this is where I just wanted to spend a little time of looking at the private side because it's a reversal from 2022. Just back one.
What's that?
I wonder why it's.
I also
this is the page, sorry. You're on the right page.
Comment about payrolls for pensioners.
Yeah.
$2 million a month. I think somebody said there was 220 pensioners roughly that are entitled to COLA.
Okay.
I have to check. But I'm wondering, is the current cost of pensioners more than the current cost of the current employees? Close to it.
I wouldn't know the answer to that.
Say that again?
How many people are currently working for the town? 500?
About 460, 470.
Okay. And the expense for current employees, is it less or more than?
I'd have to do the analysis because because the plan is closed, the town employees plan is closed, so we'd have to look at the actual participants, I think. They have to.
I don't know. I mean, it's just a number. If the payroll expense for the 500 people is, I don't know, $2 million a month, and our pension payments are $2 million a month, it's 50-50, right? I'm just trying to gauge where that's all headed, because my thought process is that's going to continue to skew in the wrong direction. To retired people costing more than the current people. And that's just, and I wonder, does that mean anything? Maybe not. I'm just.
Those are the kinds of things that we rely on Milliman
to
take into account when they're doing their valuation and doing their projections.
Well, what they projected, this is what the need is going to be, and we have to figure out the right investing formula so that it can be satisfied.
Right.
That's all. And anyway, sorry. Just when you mentioned that, maybe.
Yeah, sure. So I'm here on this slide just to look a little bit more at the private equity and the private real estate. So if I'm looking at the 1 year column, since that's your fiscal year, so you see in aggregate the private equity return is that negative 6.6%. Again, I looked at last year. Finishing last year, private equity was up 25.7% as of the asset class. Okay, so we have the lagged effect, and this is only through the first quarter, to give you a sense of where that negative return is now coming from the privates. Right below that, you see private real estate. So that's also lagged. It's down 3.7%, slightly behind their benchmark. So any of the portfolio dispersion and return versus the composite benchmark is really coming from the private side, which makes sense because we're all indexed on the public equities and the public fixed income. But yeah, so last year this time, private equity was up 25%. Real estate was up 30% on a 1 year basis of the last fiscal year. So we've certainly seen that reverse. Yeah, flip that around. But historically, it has led, you know, looking at longer periods, it's been accretive, certainly to the pension plan. So if there's no questions there from the committee, I was gonna flip through
OPEB?
the next pages, and just go to the OPEB plan. So there we go, Jared, thank you. So on the OPEB plan, now the allocation is 70-30, 70% equities, 30% fixed income and real estate. So different, so higher risk profile. So on a one-year basis, not surprisingly, that's outperformed the pension. So it's up 10.95% versus 11.3% for the composite benchmark. Again, all of that performance dispersion is going to be as a result of the real estate, because the private equity investments are really de minimis from Harvard at best so far. So there's no return yet from that 2021 and 2022 fund. So that's a stronger year. I mentioned it before. I'll just say it again. The calendar year to date for the OPEB plan is 9%.
Is one of them 70-30, one's 60-40?
The OPEB plan here is 70-30. You see the splits of the policy targets. Yeah.
That number has grown. Last time I remember looking at it, for some reason, it was 40 million. Now it's 80 million.
That's right.
OPEB?
Yeah.
You bet so.
Yeah.
They're really good.
Absolutely, yeah.
And why is that? Besides investment performance at 10% foreclosed, is it no drawdowns?
Yes, there's zero drawdowns.
Yeah,
Well, there are no withdrawals. Right, we're not, no distributions.
There's no
rather,
distributions,
There are no
yeah.
distributions from OPEB.
I'll stop there.
Just payments in.
Mhm.
Just contributions into the fund.
Mhm.
Those are the kind of funds you want to run.
Those are the kind of funds you want to run. Yes, we're really building a nice fund here.
Mhm.
Yes, for future needs. Yes.
Could I make a
Yeah, this
request? I can
one's
hear
good.
everybody but Bruce pretty clearly. I don't know where the microphone is, but,
I'm not saying anything important anyway, Tom. Don't worry.
all right, fair enough, fair enough.
Call me if you want to talk.
Yeah, so I was just looking through my notes. Yeah, those are the main high-level points from a performance standpoint. So again, it was a good way to close out the fiscal year. And it's just, you know, really monitoring and thinking about the private equity, private real estate side. Any questions from the line? Maybe then it's relevant just to go to page 22, and this is now getting into the cash flow modeling, or what's referred to pacing on the private equity side. Thank you, Gabrielle. It's nice to meet you. Oh, or Jared's writing it. Yeah, okay.
But it's nice to meet you.
Yeah. A lot of numbers here, but it's just in the interest of kind of transparency, because it's got commitments, it's got calls, distributions, legacy, as well as new. But if we just look at the very top row, 2021, the A stands for actual. Okay, so in 2021, we did a $30 million commitment to that fund. Last year, we did a $25 million commitment. And to continue along the pacing, for 2023, the recommendation would be at the $15 million, and you could see it draws down, you know, to lower amounts beyond that. And those amounts are really trying to target that 10% allocation. If we did smaller allocations in the previous 2 years, getting to 10% allocation in private equity might take 6 or 7 years. We didn't want it to take that long, and that's typical.
Mm-hmm.
So that's why you see the bigger commitments up front. Those calls will start accelerating, because when you have the commitment, usually it takes 3 years or so years. It's approximate 3 years for then that capital to be called, and then years like 4 through 9, that's when you're starting to get the returns from those private equity investments. That's kind of just the long life cycle, or what's referred to the J curve. You know, you're calling capital, you're not getting any return, and then that starts to accelerate in years, you know, say again 4 through 9. a way to see this, you know, graphically, or another, just the other point, and I've talked about this in the past, if you go towards the middle of the page and just, you know, you could stay here on the distributions, you know, you see in 2021, the actual distributions that we got were 11 million, but in 2022, the actual distributions that we got from the legacy investments are about half of that, at 5.2 million. So that's, we've been updated through MegZero, Lexington, HarborVest earlier this year, just the product of the environment. We model all those, and that goes to the next page, page 20. So that has all the details behind it, but this is just kind of a graphical representation of looking at all of the legacy investments as well as the new investments. You know, the different colors are just representing the different funds. And it's trying to build to that gray line would be targeting a dollar value that equates to 10% of the portfolio. There is an assumption in there that the portfolio is growing on a real basis of around 4% or so, but we update this, you know, at least twice a year just to give us a sense of how that pacing is looking. And so,
Can you move that over a little bit?
the best way we're looking at is hitting a 10% allocation of around, in, you know, the end of 2026. And that factors in as, you know, those actual distributions, et cetera, that really factors into what we're looking at as far as new commitments, as far as pacing. Bruce, you had a question?
Yeah, Carolyn brought up the question earlier about, you know, the distributions coming from the legacy funds slowing down. You're showing it in 50% for 22 versus 21, but now then I think I saw you going back up to 11 million in 23.
Right, because then you'd start to get.
That's a forecast?
But
You haven't received it, right?
yeah, if it's all a forecast, and so the older investments back from 2013 that you were talking about, yeah, those distributions are kind of slowing. When MegZero was talking about, say, the 2017 fund, you know, those are starting to accelerate.
Mm-hmm.
And then with respect to HarborVest,
What do we do when we run in a situation where the older legacy funds don't give us the distributions and the capital calls are from the new funds?
right?
And so now we're out of policy. Maybe if we have to make the calls
Right.
and we haven't gotten the distributions, and which could be used for the calls,
Right.
it might be at 15%, let's say.
Right.
I mean, how do we make that adjustment when and if
It,
that happens?
I mean, you kind of make that adjustment on an annual basis, you know, by updating this pacing on what actual distributions and
We
actual
don't control
commitments.
what's going on with the distributions, right? They can sit on that for, you know what I'm saying?
Yes, yeah, we don't know what the distributions would be. That's a product of, you know, of the environment, right? So it's certainly an estimate, but you update this cash flow model on an annual basis.
Okay.
And you
How
can't
would
control
we
other side.
adjust?
You can't control the other side. You can't control the distribution, right?
Right.
So,
And you can't control the capital call.
Once you made a commitment, no.
Right.
yeah,
So you have to meet the capital call either by taking from your equity or your fixed income.
right,
Right, your liquid sources of capital in your portfolio, right? Which could, yes, skew the portfolio weightings.
yes.
If for that period of time, that would, of course, take you out of your
Yeah.
target ranges.
Mm,
And you might not like how that feels.
no.
And that's happened within the town.
How that feels.
Yeah, that's happened within the town plans. We're overweight to those target allocations.
Mhm.
And it's happened in the industry, and you've heard that, you know, certainly HarborVest, the last meeting, but a little bit here today, is that that's why there's a lot of this secondary deal volume, because what's referred to as the denominator effect is that your denominator, your total portfolio value fell, your private investments kind of didn't really get marked down, and all of a sudden you've gone to an overweight allocation. So there's only two ways to do that. You could still pull from your public investments, which is still 85% of the portfolio, or if you're really stressed, I'm not saying we are here, but with other investors out in the market, then they have to sell to a, you know, to a fund that, in the secondary market at a discount. So that's kind of a last resort. You don't want to sell at a discount.
We'll cross that bridge when we get it. I mean,
Right.
I can see it. There's an
Yeah.
accommodation that's gonna have to be made if that ever arises, just from maintaining a policy, and not being too far afield of what you've
Right.
allocated.
Right.
Anyway.
There's less certainty, of course, in what those calls and distributions are compared to the public markets. There's no question about it.
Okay.
Yeah.
When would we have to make a decision on the October meeting? Our next meeting is October.
Yeah.
Right? And these funds would want docs in November, correct?
Before that, I know, so they do quarterly closes. The next close is documents getting in by August 18th or so. And then the last close, I don't have the dates here, but I'd say in that October timeframe. I don't think it's as late as November. Maybe I could have Clark pull it up. So the October meeting may be
October 25th is our October meeting.
too late. I don't know, it'd potentially be a very quick turnaround as
So
far as the document.
we don't, this agenda does not call for any votes.
No.
Right.
No.
But I would love to get a sense of
Yeah.
this group, if that's kind of allowable. I would love to get a feel from everyone of, you know, their appetite to do an allocation to private equity this year, or,
Well, you know, it's funny, most of us would say,
But I
well,
can't
we
see.
might be a little nervous about, it's probably a good time to be doing it. Just intuitively, that's my opinion. But I was gonna ask Brian, how much you said there's expecting to be a fairly sizable call in the third quarter
Yeah.
and the fourth quarter, so
Yeah.
we're in the third quarter. Are we not?
Yes, yeah, so in August,
What is that number?
we're in August, we're expecting a call for the 2022 fund. Approximately, I believe it was like 10% of the committed amount.
So,
Yeah, approximately.
okay, that's not.
Maybe Clark, you could correct me if it was that much. Yeah. But we don't know the exact dollar amount, but they are expecting to do a call in Q3 and Q4, which is certainly an acceleration.
If you took those two together, yes, how much, 10 million total? Less?
No, less. Together? Well, I don't recall, Clark, I don't know if you have it, are they expecting a 10% in both Q3 or Q4, or was that combined?
So it's 4% each. It's going to be 8% total for the 2022 vintage.
Okay.
8% total.
Yeah,
4%
so
each.
we have recommend, that worked out, I think, for August in the ballpark of $1 million. Right, Clark?
4% would equal out to about $1 million
Yeah.
from that commitment.
Right.
Yeah, okay.
But we can handle that quite easily.
Not significant.
No, and to my point earlier is like there was contributions in from employer side, and so we're leaving that cash buffer. We might need to raise a little bit more, or maybe it's too much cash, but we left some cash into the portfolio this past month in anticipation of that call. So we wouldn't even have to sell any investments in August.
You know, and we have $142 million in equity, right?
Right. Right.
Maybe too little, in my opinion, but
Um,
that's beside the point.
I
They should hit us with a $10 million capital call, I feel like, and put some money to work. But
When things don't work, are grim.
Yeah.
Or look grim.
So, I know you didn't get all the feedback that you wanted, and probably want more, but if I could, I could have you go to just page, Jared, page 39 and page 40 are two good ones. But starting on page 39, and this is just kind of backing up some data of, my words. There we are, on page 39, and you've seen this before from Harbor Vest, but in those years of like kind of disruption, which are boxed around 2001 to 2003, and then the global financial crisis, 2009 to 2011, this is looking at, you know, the total value paid to capital, the TVPI ratio. You heard Mesro Lexington talk about it. It's one measure of how well they're doing. Those have been some of the best years in which, you know, the investments paid off. You know, so those are some of the higher ratios during the life cycle. This is the life cycle of their global fund. So HarborVest has a global fund very similar to the one that the town's invested in, going back to '97. So this is again just showing some of that vintage year dislocation and investing in those times of dislocation. And then on the previous page, so that's why, you know, Vanguard, are in favor of continual commitments. And if you just went forward one page, this was a hypothetical investment. It's on page 40. Yeah, you went, yeah, this way. This was looking at one of their public fund clients. In the bottom right-hand corner, I thought it was an interesting kind of case study. I don't know who it was, but you're showing what their actual annual commitment was in the dark blue line. And you could see that they've kind of shifted those commitment periods around. And that light blue line is, well, what would be a hypothetical commitment? What if you just kept that pacing, you know, steady every single year? Well, when you look out 10 years, and this is a real example that they provided, you know, what they would have realized if they kept a commitment, a standard commitment, versus changing those values by such a big amount year over year, it's quite a stark difference between what this public fund actually committed versus if they just had a steady commitment level. So those are some additional slides that I wanted to include.
Hey, Brian?
Hi, Tom.
That's not compared to a benchmark of any sort, though, right? That's just absolute terms. Is that correct?
That's correct.
Okay. So
yeah.
if we
other material, like, you know, they will look just like the other managers showed before, is, you know, comparing it to what's called like PME, a public market equivalent.
Right.
I can't recall if it was Lexington or Mesro showed that. And HarborVest has shown that in the past. But you're right, in this case, it's just absolute, Tom.
Would it be a fair, I'm just asking the question, would it make sense to compare how our results would look if we just indexed to the S&P? And I know there are funds out there that do that, and then versus what we've done, which is sort of a hybrid approach where we have, you know, equity, traditional equity, traditional fixed income, and then we have some alternatives as well. Would it make sense to show how we've done since we've begun looking at alternatives? But I guess the reason I ask is that some of these results are compared to benchmarks that are not terribly broad, and then others, of course, have lagging indicators. So between the apples to oranges and the lagging indicators, I'm sure I'm not following completely how we're doing. I'm guessing we're doing very well, but I'm not sure. Is there a way to? I know there's a way. Is it possible to get the data on how we would have fared had we simply indexed to the S&P or done a 60-40 S&P and fixed income hybrid?
Well, one way to look at it, Tom, is in the performance report in the previous pages. The private equity allocation is benchmarked to the Russell 3000.
Yep.
Plus 3%.
Okay.
And I believe in all those periods it was outperforming that of a public benchmark.
Yep.
You know, the Russell 3000 being another proxy for the entire market. You know, Russell 1000 is like the large cap, Russell 2000 is the small cap. So that's one way. I don't think we have a way to go back and look at all the cash flows, say from Lexington and Mesro, to try to put together a public market equivalent. But then again, I believe in some of their materials, they did do that. At least one of them showed a public market equivalent in their deck. And that's the best way to do it only because, as Carolyn has mentioned and others, is they control the timing, right? It's not a time-weighted return, because they control the timing of when they call capital, so it's lumpy. Maybe you get 2 commitments a year, 4 commitments a year.
So I think the most compelling argument in favor of the managed toward the percentage allocation toward private equity is in the work that both you have done and Milliman have done from an actuarial standpoint to support kind of the long-term valuation of the funds with that allocation toward private equity kind of quantified into the math that they do. And it really shows kind of how supportive it is to the long-term valuation support, to the discount rate, right? And kind of where we get to relative to the discount rate.
Right.
So, I mean, from my standpoint, I guess I gotta say, as much as I do not like private equity, you haven't figured that out, I just don't get it. I'm a public equities person. I just really think that there is a very valid and important place for it in a diversified portfolio. I think we have found a great way to do it. I'm very comfortable with HarborVest and with you as our partner overseeing it. And I'd be very comfortable following the path that you have laid out. And I would be comfortable doing with it this year. And I really do hope that they would buy low. As a sage investor would. But I would like to get a sense of how everyone else feels, because we're going to have to act on it and vote on it in the next meeting and move pretty quickly.
Well, I can tell you right now that I think that, if you'd asked me a year ago, and I think I made some comment that this private equity.
I'm sorry to interrupt again. Could Bruce? I think you're speaking. Could you just lean forward, please? I'm sorry. I do think what you're saying is important.
Is there a microphone? I think I said a year ago that private equity I thought was in a pretty dangerous place, and I didn't trust the marks that I saw from people, and we're really in the dark about valuation of these things. But as we look forward, now this quiet period of illiquidity and valuation adjustment, and obviously new private equity emerging because of new businesses, et cetera, I think there's another boon in that business coming. And over the long period of time, the real value in it is that history says that you're going to get something like, a well-managed private equity fund will return 5% more than a public equity S&P 500. Okay, that's it. And you have to trust that. We don't, and any given year we look here and we can say, oh, things look, I don't want to be in an illiquid place, cash is going to be king, blah, 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 blah. We can't think that way. This is a long road, and I think it's prudent to have the diversification, even though some of it we can't decide on the timing. We're at total mercy. All right, we can make comments to Brian about, okay, we want more public equity. Let's move it from 50% to 55% or whatever. Right. Less bonds or stuff that's publicly traded. Right. Liquid investments. Right. But we can't really do that here. So I just accept the theory that there's a place for it. It's just the amount of allocation, and you can be wrong about the timing, but you'll be right about it over the long term. Just like you could in the public market.
Yes. You take down the screen share. Let's see. Tom, Chris, Eric, Jim.
Yeah, this is Eric. Eric Newman. I'm definitely for continuing. We came up with a plan that we're going to invest every year into these new vintages. We're still in the early innings of the relationship with HarborVest. I think we should continue. And don't forget, in market disruptions, maybe the buyouts are slowing down, but you also have new technologies coming out very rapidly. You have a lot of different transitions, and a piece of that is in that early stage, high growth. private equity venture capital pieces, and those are going to grow. They're going to be bought out by the next layer of bigger private equity firms who buy the venture capital companies that grow, and then they keep being recycled. Eventually, some of them do go public, and you gain, or they'll be sold off to strategics. So there is, you can't time it, but you're going to definitely, over time, making those consistent investments will achieve, I believe. And it adds that diversity. When the public markets were down, the private equity held up. Maybe question the valuations, but if we wrote down everything because the public markets went down, it'd be much harder to bring it back up. Once you bring down the values, it has a true value. So I'm for continuing the investment, making another investment.
You can have a vote next.
Carolyn,
When we have a full
Eileen-
meeting, just have,
I lean toward it as well. I would love to see, I wish we had a summary document sort of describing how we've done relative to public markets as apples to apples as possible. But if that's impossible, I'll just say that in general, what I've heard and seen is encouraging.
I'm for it too. I appreciate what Bruce had to say. I thought he summed it up very well. So I'm on board as well.
Would there be, we've had HarborVest before. They're always committed to providing any information. They gave me a huge deck. I only put in a few slides just in the interest of keeping it low. Is there specific information that would be
I think you
helpful?
can put it in layman's terms for everybody. You could just say, HarborVest has been around for how long? 10 years? 15 years?
Over 30 years.
Right.
Yeah.
Just compare their funds to the S&P or something, and give it to some that everybody can understand. And is there an advantage? Are we receiving a return that justifies the illiquidity? Period. That's what it comes down to.
Yeah, I think with the Lexington and the Mesero, the numbers show that. And then HarborVest does have, just like I showed on page 39, they do have their global fund, which is most equivalent to the one that you're invested in, against the public market equivalent. So they do have those.
Yeah.
They do have that. Well, I know that we've seen it together in the past, but I will show it again.
A top quartile fund is going to show those outperformances.
Right.
Period.
And I think they're historical, which you can never, bank on, but I think their historical performance for that global fund, which is diversified across stages, type, and geography, has been more in the ballpark of 500 basis points over the public market equivalent.
Yeah.
And so much of private equity is contingent upon being with the right investors, with the right general partners, and that is really born from long-standing relationships. The best private equity general partners are usually closed. That's why Vanguard didn't decide to do it. Vanguard wouldn't be able to get into it, Thoma Bravo. We don't have the relationship. HarborVest has been investing with them for, decades.
Yeah.
So when Thoma Bravo goes to raise a new fund, who do they call? The people that they've been investing with since the beginning. If you try to build a private equity program, say on your own, whether it's Vanguard or something, now you don't have those relationships. You don't. And a lot of these funds are closed, or they're only going to raise a certain amount of capital or a certain amount of funds. So it's a long way of saying that those relationships are so key in the private equity marketplace, and who you partner with. Yeah. So that's the high level view of why Vanguard partnered with HarborVest, because of their decades of experience, their relationships, that they have expertise in primaries, secondaries, co-invest. It's a global platform. And then, of course, the fees are much lower than we've seen. And that's where the scale of Vanguard trying to negotiate and fees lower than someone else can get.
All right.
All relevant, really good questions. Those are the right ones to be asking and doing the gut check on. So always welcome that.
Okay, so in October, we'll do the vote, right?
Yeah.
In the
You
interim.
can vote no, Carolyn, and, because most people can vote yes.
Hey, you know what? It's okay.
So,
Hey, sorry to repeat, but if we could get the package, especially since we'll be voting on that, a very substantive matter, a week ahead of time, that would be great. I know Jared said he would, but I just want to reemphasize, I'd be
Yeah.
interested in getting the package a week ahead of time if possible.
not a problem, and let me know, is like, in the past, I had just sent, I'm blanking on who was, running the meetings, like from the agenda perspective, Chris and stuff like that. And even in this instance, I sent the materials last week. If you want me to distribute them myself directly to the JRIB, I'm glad to do that. But yes, I always, look to have the package to you at least several days in advance. In this case, I don't know if it was, but yeah, I did send it last week, but I can send it to the entire JRIB if you prefer.
Jared just sent me some supposedly tonight. I'm not getting it.
Did you not get something from Gabrielle?
I just did get something from Gabrielle.
Last week?
On the 20th.
Yeah.
A new name appears.
A new name, yeah.
Are you new?
I am, yes.
Oh, okay.
Yeah.
So,
I'm Bruce.
well, December to the town, but this is
Right.
my first JRIB
Right.
meeting.
Yeah.
Oh, okay. Well, okay. Welcome.
Right, we try to get everything to you a week ahead.
Yeah, and I saw something
Right.
from.
So yeah, noted, Tom, and I'll continue to do that.
Yeah.
But I always want
Thank
to
you
see
all.
the material several days in advance.
I appreciate it. Thank you.
Yeah. All right, that's it. All right, we're going up to you. All right, guys, we're gonna move forward. Here we go. We're gonna go forward to the CFO
Here we
report.
go. All right.
Marketing materials you sold us on, Harvard West in the first place, this probably should suffice, right? I mean, we made a decision based upon the presentation that was made initially about Harvard
Right,
West.
a couple of years ago, yeah.
And anyway.
Yeah.
Okay, CFO report on the cash flows of each of the funds. The town employer contribution is, on point with the, actuarial ADAC amount. Cash transfers in, go toward paying toward the benefits that are paid out each month. Employee contributions. So per the boards, I know we've had many conversations about this.
Excuse me, Jared, are you going to be
and-
projecting the statement on the screen?
Oh, I'm sorry. Yeah, no, I have it up here and I forgot to share it. Hang on one second.
Thank you.
Got that?
Great, thank you.
Okay. The employee contributions, we talked about this, many times. I'm happy to say that next quarter, we'll be showing these on a monthly basis, both on the pension and OPEB side to show a monthly amount being, of cash actually going into the fund. So starting next quarter, you'll start seeing that. With the hope being that, about a year from now, that we'll be, running this the same way. And sorry, I'm in pension right now, but I'm kind of projecting forward to OPEB, that OPEB would be run the same way as the pension fund.
These are pension fund numbers?
These are pension fund. I'll get to OPEB in a minute, but kind of jumping ahead a little bit. But, payments to the beneficiaries, legal services, which is related to primarily related to the services which were mentioned before by Megan, that we paid Shipman and Goodwin for their work on the pension plan. investment management fees, the consulting and actuarial fees are, you know, those are Milliman's fees that could be related to the transition to their administration of the plan.
Is that a year-end total over there?
Yes,
For what, 22 or 23?
for 23, yeah.
23 fiscal year ending June 30th?
Yep.
Okay.
Any questions there?
No.
Bruce says no. Let's go to,
Let's get right to the bottom line here, Jack.
well, you know, it'll, I think once we move into the, you know, getting it into the, you know, same model as the pension that,
Okay, the first one was the town, this is the police and fire?
This is police and fire pension.
Okay, and then you have one for OPEB also?
Yep, for each of them.
Okay.
You know, same categories. A little bit more employer contribution, because the police and fire is continuing, and the number of employees there are, although albeit, you know, modestly, are increasing, whereas on the town side, you have people transitioning out of it. Nothing.
So you just answered my question.
Here.
No.
You're right.
Yeah.
So OPEB, and this is where we, you know, at the end of the year, we do the true up. So the contributions here would be both from the, you know, the aggregate of both the employer and the employee contributions, and the, you know, the true up at the end of the year, because we're dealing with cash here, and the payments go in and out of cash. So it'll, like I said, it's gonna make more sense when we change the approach. Milliman's fee for their valuation.
Okay.
And then police and fire OPEB. So yeah, again, what'll happen starting next quarter, this will be broken out. We'll see contributions broken out, and you'll see a separate line for the employee contributions on a monthly basis going into it.
Who else makes the contribution? The town?
Town. Yep.
Town and the employees?
Yep.
That's it? For that line?
Yep.
Okay. Because I saw 1 million on that last one. I don't know, it was sort of like an odd, just something.
Yeah, that was the, you know, the way that the true up worked out, and it made, you know, it was probably plus or minus a little bit.
Okay.
There was a
All right.
little around.
Yeah.
Yeah.
Okay.
Any questions?
All right, no questions? All right, if I can, ask you guys for your attention, for one more thing, guys, is it possible, if I still have you guys with me and we have a quorum still, can we do the minutes very quickly? Eric Calver was kind enough at the beginning of our meeting here, he sent the email around with the minutes around to all of us. If you could take a moment to just call them up. And so that way we don't have to carry them over to the next meeting.
Okay.
Please. So this is a motion to review and approve the minutes from the regular meeting from Wednesday, April 26th. Someone,
I'll second that. That was your motion.
I didn't attend the meeting. I don't know if I can, I
Okay, so
cannot, I'm gonna be abstaining.
I'll move it then. I'll
All
make
right,
a motion.
Jared makes the motion. Do we have a second?
Second.
Chris is a second?
Yeah.
All approve, say aye.
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 Okay, great. Okay, I'm going to abstain because I was not in attendance.
Okay.
All right, thank you. Thank you very much for doing that. On an old business, guys, I'm gonna move forward. I did want to point out, guys, if you didn't see in the news, Allianz Structured Alpha Fund pled guilty to the U.S. government and paid a $6 billion fine. Just thought I would make sure you guys saw that in the news.
What do we get?
We got, we
Made whole.
we were made whole on it. We led the class.
Mhm.
$6 billion. It was, how unusual, a guilty plea,
Yeah.
a guilty plea.
Wow. They were.
They, yeah,
They were. That
So-
is surprising, yeah. They were reckless in what they did.
they were reckless in what they did, and we saw it, and we knew it, and we
Yeah.
sued them, and we led the class.
Mm.
So I just wanted to point that out to everybody. I don't know if anyone else has any old business, but I want to make sure you saw it. Any new business?
Motion to adjourn?
All right, motion to adjourn. Bruce? All
Yeah.
right.
Second.
All right, guys. All in favor?
Aye.
All right.
Aye.
We're done.
All
See
right.
you guys, see you in October.
Thank you.